So we're getting some mixed signals when it comes to the consumer, at least here in the United States. What's your take on the strength of the consumer, and how does that inform your opinion about the equities market?
Yeah, so we believe the consumer is strong. And of course, you see it starting to weaken across the edges, which is only to be expected from this level of strength. But to your point, Frank, that makes this inflation problem so complicated. And I think we think it all boils down to the fact that the interest rate sensitivity of the economy, especially the US economy, has really come down. So just interest rates are just not working to dampen the economy.
Yeah, definitely not working to dampen the economy, at least not as much as I think the Fed had hoped, trying to get down to that 2% inflation target. I also want to talk to you about just the higher for longer environment we're in right now. You recently put out some research calling the move higher in yields remarkable. So is it remarkable in a good way for investors and your clients? You're advising them to get more into bonds right now, and if so, is it short term or long term?
Yeah, well, it's about one question. Is the bond market doing the work on behalf of the Fed? Or has the Fed lost control over the bond markets? And that's why remarkable is either positive or negative, deciding on how you answer the question. We all know what's happening. We know that there's a huge supply of bonds, and there's a lack of demand of bonds because the world's largest buyer is no longer a buyer anymore. And that means that yields go up, prices go down. So we know what's happening. Is that dynamic over yet? Probably not. That's why we're still advising the shorter duration, the shorter end of the curve. But I think more importantly, we are advising our clients to really have a serious calculation of risk. If your risk-free is 5%, you need to really start looking at risk differently.
So when you say look at risk differently, obviously you're saying you need a higher risk premium when it comes to equities. But does that mean you stay away from certain sectors? Do you focus more on different sectors? Do you focus more on dividends, for example?
Yeah, well, definitely. And I think, Frank, we've spoken about this investment manifesto that we've had in the past, but it's really about getting really nitty gritty and looking at businesses. Because if you look at the broad US equity markets, the risk reward of buying equities in the US just doesn't make sense. You're much better off buying bonds. Added to that is the fact that, analysts are going for more than 10% earnings growth next year, which isn't easy considering at the edges you see things starting to weaken. So again, it's all about specific companies, underlying business models. Where do they have pricing power?
So one question for you. I think we're going to be asking all guests about this. Of course, the yield on the 2 years is very attractive right now, basically 5.2%. But if we're in higher for longer, why not wait just a bit longer? We'll let those yields just creep up a little bit higher, or lock it in on the longer end, and then you have that risk-free 5% or so. I'm just looking at the 30-year right now, 4.96% for a longer period of time.
Yeah, and that all boils down to this inverted yield curve, which needs to get to normalization eventually. How is it going to become more normalized? Is the short end going to go up further, or is it going to be coming from the short end of the curve, or is it going to be coming from the long end of the curve? So if you lock in these exciting rates, longer term, longer end of the curve, and you see yields continuing to go up because there's still more and more supply coming to the market, then less and less demand, that can be a painful trade. We feel more comfortable having a stronger accent at the shorter end of the curve, especially looking at the yields that you can get with much less duration risk. It just feels more comfortable.